Income tax. Yeah, for most of us, that word alone can be kind of intimidating, right? It just feels so complex. But what if we thought about it differently? What if we pictured it as a journey your money takes every single year? In this explainer, we're going to do just that. We'll follow the path step by step from the moment you earn it all the way to the final tax bill. I mean, we've all had that moment. You look at your pay slip, you see that salary number, and then you look at what you actually have to pay in taxes, and you just think, how? How on earth did this number become that number? Well, it's not magic and it's not random. There's a very specific roadmap the government follows, and understanding it is the key to getting a real grip on your finances. So, here's our roadmap for today. We're going to start with the absolute basics. Then, we'll figure out who actually has to pay and where they have to pay it. We'll break down the 5 ways you can earn money, and then, the good part, we'll see how you can legally shrink your bill before we calculate the final number and get it filed. Let's get started. All right, every journey has a starting point, and for us, it's right here, with the fundamental rules of the road for India's entire tax system. So, what even is income tax? Well, at its heart, it's a direct tax. Think of it this way. It's a payment that goes directly from you to the government. It's not like GST, which is kind of baked into the price of stuff you buy. And the whole system, all the rules and regulations, it all comes from one massive instruction manual, the Income Tax Act of 1961. Okay, here's a fun little legal twist for you. When the tax law says person, it doesn't just mean you and me. In the eyes of the tax department, a person could be a huge company, a family business, a partnership firm, or even your local city council. Basically, if an entity can earn money, it's considered a person that has to pay tax. You know, timing is absolutely everything when it comes to taxes. You earn all your money during one financial year, from April 1st to March 31st, and that's called the previous year. Then the next year is when you sit down, do all the math, and pay the tax on that income. That's the assessment year. So it's simple. You earn first, you get assessed on it later. Next up, we've got to figure out the where. Because believe it or not, your physical location during the year plays a massive, massive role in what slice of your income the government can actually tax. Now, what's really interesting here is that this isn't about your citizenship or your passport. For tax purposes, it's all about your residential status. And based on how many days you're physically in India during a financial year, the government will slot you into one of these 3 categories. And this is why that status is so incredibly important. If you're what they call a resident and ordinarily resident, or ROR, you're taxed in India on your global income. That means everything you earn anywhere on the planet. But if you're in the other 2 categories, you only pay Indian tax on the income you make or receive in India. Yeah, that is a huge difference. Okay, so we know who pays and we know the rules about where. Now let's get to the what. The government needs a way to classify every single rupee that comes your way. And they have this really neat system for it. Everything, and I mean everything, gets sorted into one of these 5 buckets, or what they call heads of income. Your monthly paycheck? That's salary. Rent you collect? House property. Profits from your business, gains from selling stocks, even the interest from your savings account, it all has a home in one of these 5 categories. Now we get to the fun part. This is where a little bit of strategy comes into play. You see, you don't pay tax on your total income. First, you get the chance to legally reduce that number. Let's find out how. The very first tool you have are exemptions. Think of these as certain types of income that are just off limits for tax. The government basically says, nope, we're not even going to look at this money. Things like income from farming, money from a scholarship, or certain retirement benefits are completely tax-free right from the start. After you've set aside your exempt income, you get to use deductions. This is where you can actively lower your bill by telling the government about certain investments or expenses. The most famous one, the one everybody talks about, is Section 80C. This is a big one. It lets you slash your taxable income by up to a whopping 1,50,000 rupees just for putting your money into things like your Provident Fund or a life insurance. And hey, if you're a salaried person, you get a bit of a freebie. It's called the standard deduction. It's a flat 50,000 rupee cut right from your salary income. No questions asked, no bills to show. It's just a straightforward way the government acknowledges that you probably have some small expenses related to your job. Okay, deep breath. We've added up our income, we've subtracted all the exemptions and deductions, and now we're left with our final net taxable income. This is the number we've been working towards. Now it's finally time to calculate the actual tax. And just as you get to the final stretch, you hit a fork in the road. You have to choose the old regime or the new regime. The old way lets you use all those powerful deductions we talked about, but the tax rates are a little higher. The new way offers lower, simpler tax rates, but you have to say goodbye to most of those deductions. There's no single right answer here. You literally have to do the math for both to see which path saves you more cash. Now, you might be thinking, do I have to pay this whole amount at the end of the year? Usually, no. The government has a clever pay-as-you-go system called TDS. For example, your boss deducts a bit of tax from your salary every month and sends it to the government for you. It's a way to make sure you're paying your tax in small chunks so you don't get hit with one giant, painful bill later. But what if you're a freelancer or you run your own business? There's no boss to deduct TDS for you, right? Well, that's where advanced tax comes in. If your total tax for the year is going to be more than 10,000 rupees, the government expects you to pay it yourself in 4 installments throughout the year on these specific dates. We are so close. We've tracked our income, we've reduced it, we've calculated the tax, and we've even paid it. There's just one final, crucial step to complete this entire journey. You have to officially report the whole journey to the tax department. This is done by filing an income tax return or an ITR. Think of it as your financial report card for the year. And if your total income is more than the basic tax-free limit, filing this report card isn't optional. It's mandatory. So you hit submit. What happens next? Well, the tax department gives it a look. For most people, it's just a quick, computerized checkup, a summary assessment. But a small number of returns get randomly selected for a much deeper dive, a detailed manual review called scrutiny. And of course, if you don't file at all, the department will just make its own assessment, and you probably won't like their guess. So, there you have it. The entire journey your money takes through the Indian tax system. It's a logical process, with clear steps and rules. But it also makes you think, doesn't it? With 2 completely different tax regimes to choose from, and a whole web of deductions and exemptions, is this path as simple and as fair as it could possibly be for everyone? That's a thought we're thinking on to. Thanks for coming along on this journey with us.